This is video 2 of Audible, and we are having a look at the solution. They asked us for the prior period error note. So that is the note that is in the solution, and it always starts with a narrative paragraph telling us what the prior period error was, what happened. So it's a paragraph: during the year ended 31 December 2017, the revenue from the Black Friday promotion was incorrectly recognized and measured. You also then need to say, were you able to go back retrospective as far as right to the beginning when it happened? In this case, only 1 year. Could you go back and fix it? You do that if you have enough information. This is not about, was my accounting system able to be opened? That is not what we are saying. We are saying, did you have enough information to go back retrospectively, correct the error as if it never, ever happened? Even if that means you did it by hand, use the TB that couldn't be changed due to the accounting system not being able to open, but you corrected it on paper, with pen and paper. Okay? Can you go back? Were you able to? That's what this is saying. And it's only 1 year back, so we say the effect of this retrospective restatement, we could go back, affects the following line items. Very important. If you look at the note for IS 8, for a prior period error or even a change in accounting policy, it's about line items. Which line item on the face of financial statements that had been published, that users have seen, which line items are now a different amount, that your users need to go and look at. This line item is different from what it was before. Now in this question we are busy with 2018. It's a prior period error note. You can not have a 2018 column with amounts. If you do have a 2018 column, we will negative mark you. 2018 is the current year. You are busy with that year. If you see you made a mistake, fix it. You're still busy with it. Do you not tell your users, oh, there was a mistake while I was setting the financial statements, but I fixed it, so now it's all okay. Prior period error deals with prior periods where the financial statements have already been issued. Users have seen those financials. They have made decisions based on those financials. Now all of a sudden we realize what we published was wrong and we go back and fix it. So you will not have a current year column in a prior period error note. In this specific example, the error was only 1 year ago. So you can also not have the third column, the opening balance of the prior year. You will only have that column, opening balance of prior year, if it happened before the prior year. If it affected the opening balance of the prior year. So if it happened 2 years ago, 3 years ago, 4 years ago, 5 years ago, longer ago, then you will have that third column, opening balance of the prior year. But because it was an error in last year, in 2017, that is the column we see. The line items you need to mention, you need to every time say, was it an increase in that line item or a decrease in that line item? In this case, increase in revenue, we'll go and have a look at the amount just now. Decrease in other expenses. Then that has a net effect. Revenue increases, so profit for the year increases. Expenses decrease, that's good, then profit also increases. So there's an increase for profit for the year and total comprehensive income for the year. There was an increase in trade and other receivables, an increase in trade and other payables, and an increase in equity retained earnings. Line items that you can see on the face of the financial statements. What was done was given to you in the question. What was done was that a bank amount was recognized because money was received. 10,000 subscriptions were received. They each paid money. Debit bank. Bank is usually not where the error lies because we have monthly bank recons and we will pick it up very quickly. We recon to physical amounts in your bank. You compare it to your bank statement. So usually bank is not where the error is. What else did they do? What was done? They created a promotion expense and then they recognized revenue for the full amount of the subscription of 120 Rand. What should have been done? Now that we know what was done, and we are looking at only 1 month, December 2017, that's the prior period. What was done, we know. What should have been done? Well, what should have been done is that you should have recognized revenue from the Amazon Echo Spot, not only from the audio credits. Just because the Amazon Echo Spot was given for free does not mean we don't recognize revenue. It is identified as a separate performance obligation. The transaction price needs to be allocated to each performance obligation based on standalone selling prices. If you were to sell it separately, would it be 0 Rand? Would it always be for free? No, it has a price. So you would have had to allocate the total transaction price to each performance obligation, including the Amazon Echo Spot. The Amazon Echo Spot control went over immediately. On the day that the Amazon Echo Spot was provided to the customers, immediately they had control. Immediately they could use it. Not only with Audible's credits, they could use it with anything else. So revenue is recognized when the performance obligation is satisfied by giving control over. So you can immediately recognize the revenue from the Amazon Echo Spot. You don't receive the money immediately. This is a 12-month subscription. So you receive it over 12 months. So at this point, it's either you recognize a trade and other receivable, a debtor, or a contract asset. What is the difference between the two? You recognize a debtor when the only thing that you are waiting for is the passage of time. Time will pass and you will receive your money. You recognize a contract asset when you still have to perform. You will not get that money unless you perform. Now, you could probably argue both ways, and we would have marked both of them. Both of them, in any case, affect your trade and other receivables, which is the line item in which it was included. If we had asked the journals, could have probably argued both ways. The one way is to say, but I am only waiting for time to pass for the Amazon Echo Spot because I did what I had to do. I gave them the item. But on the other hand, I still have to provide audio credits for all the other months, and they will only keep paying the subscription if I keep giving them those credits. So you could probably argue that you will not receive any money for the next few months if you don't still give the audio credits, so you still have an obligation. What else should have been done? We should have recognized the bank amount that we really received, cash, that the payment for the subscription. How much did we receive? We had a discount of 10%, so we only received 90% of the amount. The question is, can I recognize revenue for the audiobooks? We provided them with an audio credit. No customer used that credit to buy books. At the end of December 2017, no audiobooks had been bought. Have we satisfied our performance obligation? What is our performance obligation? It's selling audiobooks. That is the main business of this entity. Have we sold an audiobook? Have you provided an audiobook? No. So what is the money we received? It's income received in advance. For 1 month, we have received money. We've got bank. We have not sold audiobooks, so we have not satisfied the performance obligation. We cannot recognize revenue. If you receive money and you cannot recognize revenue yet, it's income received in advance. How will we calculate that revenue? Well, it's the portion of the transaction price that is allocated to this performance obligation, the audiobooks performance obligation. The balancing amount is your debtor or contract asset for the Amazon Echo Spot that gets a bit reduced because you have now received 1 month's money. So you reduce the debtor of what is still owed for the Amazon Echo Spot that you will receive over the 12-month period.